So today's episode is simple, huh?
Very simple, straightforward.
Simple.
Yeah. Keeping it simple today, Matt. Kiss.
It's like one weird hat. Oh, kiss. Yeah, kiss this. Wait, people may not get what that is. Matt Robison, Mike Morton, Financial Life Planning. If you're wondering what that acronym stands for, it's keep it simple, stupid. It's not an invitation of some kind from Mike.
Yeah, that's right. No invitations. Why isn't it keep it stupid simple? That's what I think it should be. Keep it stupid simple. Yeah, keep it stupid simple.
Are you calling me simple? I can see why it's not. It's because you're insulting the listener.
No, keep it. That would be the other way around, Matt. If I was insulting, I'd be like, keep it simple, stupid.
But it sounds like in your sentence, my name is simple. That's what bothers me about it. Today's is simple. I actually kind of love it. It's like Hannibal Lecter. It's like simplicity. Marcus Aurelius. It's really simple. It's really important. I forget. This is the kind of advice that I forget about all the time, and it's like, oh yeah, this kind of explains everything. What's the thing that like explains everything?
The thing is that fees. I got kind of worked up this week, Matt, because 3 different kind of stories came across this week, all around fees that investors pay that Wall Street is collecting. Wall Street makes up products and has tons of products, and the whole thing is to extract, fees from investors. So that's what they do. You have to understand the fees that you're paying as an investor. There's going to be some cost to, do investing, right? We use technology, there's people involved, there's software involved. So there's going to be costs. You just want to understand what it is you're paying for and what it is you're getting. And does that make sense for your situation? So I'm going to tell 3 different stories today about different fees that came across my screen. And the important takeaway is just understand what you're paying, what you're getting for it, and are you getting value for that?
I think you buried the lead.
Oh, yeah.
So, you know what grabbed me? In what you were saying before we started recording? You said fees are the number one predictor of returns.
Yeah.
Like that's it. That's the simple part.
Yeah, so there's that piece as well. So fees, this is Morningstar does a ton of research on different investments and funds and all kinds of stuff. And they've got their ratings, the different stars, the gold and silver and different levels of stars and stuff.
Wait, what is Morningstar?
Morningstar is a research company that provides services for advisors and investors. You can go to morningstar.com. They have tons and tons of research. I go there all the time just looking up different funds and stuff.
I honestly, before you told me that, I thought it was the folks that make this like meat substitute that gives you diarrhea. I really, because Morningstar that is also a brand that makes meat substitutes. Morningstar makes the veggie burger that we like in my house, but that's not what this is.
That's not what this is.
Okay, you really had to clarify that for me. Okay.
It's good, man. I love the questions. We got to let's keep it simple, stupid.
Keep it simple. For me, there's really no level of simple that you can sing to. That's
right.
Loud.
That's right. So it's a research company. You can go, and I'm there all the time looking up different things because they consolidate a lot of information about funds and investments. So, but there's a lot of research and the number one predictor of this is for mutual funds, for what's going to be kind of a better mutual fund, predictor of success. Which fund should I choose? And you can look at all kinds of things, big companies, small companies, investing in this style or this style. And the one thing they keep coming back to is that fees. The lower the fee, the higher the return. And it makes sense, right? The lower the fee, the less you pay in a fee, the more return you get as the investor. And so it's one of the number one predictors of future success.
I am just glad to be reminded of this. It's so 101 level. It's so important. And I forget about it. Like it's the place kind of to start is just decrease the amount of drag on your investments in the form of fees, and you're gonna do better. It's sort of the one thing you can control. You can't control the market. You can control your fees.
Yep, that's exactly right. So that's why we always tout on this show, right? Low cost index funds. Just buy the whole market. You don't need to be in actively traded stuff, and just keep the fees very, very low. And good news now, there's tons of low cost index funds, so they're pretty easy to find. And hopefully most, our listeners are already tuned into that.
So give me your first story to illustrate this point. my first veggie burger of the morning of why we should be leery of fees.
Yeah. So one is these on this subject, the interval funds. This was in the Wall Street Journal, an article I was reading this weekend. Again, this gets back to Wall Street kind of making up products. You might remember the CDOs, the collapse during the housing crisis.
Wait, the Great Recession? Yeah. I did try to block that out, but it keeps injecting itself into my mind. Like, like when I was kidnapped by aliens and it keeps coming up and that's a different thing.
Well, I thought maybe the pandemic, might have erased, some of the further back
history. That never happened.
Right.
No.
So with these low cost, and here, it's a good example, like low cost index funds. There's not a lot of money to be made. I mean, they're really low cost, right? And they're still, you still go online, you got to click the button. So like I said before, there's software involved, there's some people involved, even in index funds, there's people involved managing that, have salaries. So there has to be some cost, right? But it's very, very low. So they're not making, a ton of money on this stuff. So Wall Street, right? They got to make up some other stuff to sell you, so that they can make money, right? So one of the new ones is these interval funds. And they've been around for a while, but they're gaining momentum, or they're gaining more dollars, going into them. And what it is that they tout it as, oh, you want to be invested for the long term, then you don't want to be in a fund where everyone might sell at the wrong time. Okay, because you want to be a long-term investor, and if everybody sells the fund all at once, then it could really drive down the price. So we're going to create these funds that are a little more illiquid. You can't get out of them as much. All right. We only have some redemptions, how much can be sold. And so that's these funds. And it's a good pitch. It's like, yeah, I want to be a long-term investor, so that sounds good that it's not going to go down at the wrong time. But then you pull up under the hood and it's like, they're higher fees, under here. And their fees, even on the borrowing of money, there's all kinds of layers, in the article we'll link to. But it just caught me again as like another product that's a little bit complicated. The pitch is simple. Hey, you want this idea? Yeah, that sounds good. I want to buy that thing, for that. But when you start uncovering and go under the hood, there's just fees upon fees. And it's like, yeah, this stuff is just what is made up by Wall Street.
I feel like as a matter of professional courtesy, you try to be polite about the people who sell these things and you pull punches. I don't want to ruin that vibe that you're trying to achieve on your show. That said, I think all of this stuff is complete BS. I don't want to offend my Wall Street friends, but I want to offend you a little bit. It's like in Goodfellas. I want to insult you a little bit, just a little bit. It's all a marketing ploy to get me away from my super duper low cost index funds. I mean, it reminds me of, are you a fan of The Wire? For fans of The Wire out there?
Yeah.
It's like when Stringer Bell is trying to sell drugs and he goes to take marketing classes, business classes, and he asks his professor, if I have an inferior product, what do I do? And the professor basically says, marketing. And you're just, it's BS and it drives me crazy. So what you're saying is interval funds, marketing, it sounds like an appealing idea, but also you could just, have you done the comparison? You could just do index funds, right? Like, have you tried to compare that?
Yeah, these ones, I mean, it's really impossible to compare this stuff, right? Because there's so many different layers to it.
Sure, they make it impossible.
Yeah. Well, here's the other thing. I mean, just be wary, as you're saying, Matt, like wary of things that you don't quite understand. All right. Where the headline's nice. Like the headline is, oh, hey, you can currently get a 5% return on a safe, market index, money market funds. But do you want a 9% return? Would you like an 11% return? I mean, that sounds great. Like, yeah, I want 11%. Well, there are funds that give you 11% return. I mean, why wouldn't you want to be in that? Well, because when you start reading about what's in there, they're riskier, there's higher fees, your total return is going to be less, all kinds of little things. But the headline is 11%, 11% return.
There's no free lunch. There's no free lunch, right? You're either going to pay for it. I mean, the simplest calculation is you're either going to pay for it in risk, if you're getting a higher return, taking on more risk, or you've got more fees. And, there's no free lunch. All right. What's your story number 2?
Number 2, this is something that came into my email. So I'm a big fan of HSAs. right, Matt? We love the HSA accounts.
If I were your wife, I'd get a little nervous about your relationship with HSAs.
No tax ever. I love
JD
it.
Vance on his couch.
All right, no politics in this show.
Sorry, no
Matt.
politics. I'm so
That's
sorry.
your other show.
JD Vance has a completely clean public record and has no. I'm going to drop the whole couch thing. People Google it. It's worth it. It's so fun.
So we have an HSA. Love my HSA. We just had the show about HSAs, how best to use them. So have all the money invested, contribute and invest. And an email came. It just is from HSA Bank. That's the one where our HSA happens to be. And so I got an email from HSA
Wait, that's a
Bank.
thing? That's a thing? There's a thing out there called HSA Bank?
HSA Bank.
Snakes on a plane theory of naming things. It's like, well, what do you do? It's
I'm not sure what they do.
Yeah. Okay. So you're with HSA Bank.
Yeah, it's interesting. I might have to look that up.
Yeah, right. Exactly. The restaurant I went to, food on a plate. Yeah.
Food on a plate.
What'd you get? All right. So you're getting HSAs from HSA Bank.
HSAs from HSA Bank. And I got an email saying they're switching up like their offerings, right? So something new they're offering or changing it up. And it's all touted as like really great. Oh, we can, you can do the investments with this actively managed investment. And I'm like, oh, geez, that does not sound good. I already can see fees, written there. Right now I can invest on my own. And it's linked to Schwab currently. So it's through HSA Bank, and then you have like a Schwab login if you want to self-manage your own HSA, which is great. And there's no fees involved. You just transfer the money, and then you're in the Schwab, and you just, buy some stuff or whatever, low-cost index funds. Well, they're switching it up. They're not using Schwab anymore. They're like doing their own thing. And I noticed that it's going to be a 0.1% management fee. And I was like, it's a self-direct, right? So they're kind of vertically integrating, getting rid of Schwab and adding some fees in the fine print, of course.
Oh my gosh. It's, first of all, actively managed is a euphemism for you pay us more money.
Right.
Actively managed means you pay more. There's no other interpretation. I don't want Mike to offend his colleagues. I'm going to offend his colleagues. It's ridiculous. There's no free lunch. So there's no one out there who is managing their way consistently to greater returns in the long term. There is no one who has the magic formula out there. There's no Easter bunny. There's no tooth fairy. There's no Queen of England. Okay. All right. Yes. So your HSA Bank is, well, I guess that joke doesn't work anymore because there is no more. Eventually, someday there will be a Queen of England again. What's Kate called? She's the Queen Consort. Is she the Queen of England?
Consort.
British royal.
You just drop that last part.
Come for the smart financial management. Stay for the royal trivia.
That's right.
So wait, are you dropping HSA Bank now?
No, it's going to be a future episode. Stay tuned. But it was funny. It was like, and I love how they name this stuff. 0.1% for choice, 0.25 for select, and 0.35 for managed.
Oh gosh. You know what really bothers me about what you just told me is that there is someone, I'm going to offend some other human being today. I'm on a roll.
There you go. You're on
there
fire.
is someone who gets paid more money than we do to come up with this drivel. There is some marketing person who's like, we'll call this choice. We'll call this select. By select, it means we've selected you to pay us more money. This is so offensive.
You've been selected.
Okay, marketing genius out there. I appreciate that your boat is getting paid for by my selection.
Now, I'll give you the flip side. The reason I might just stay with HSA Bank, which would be fine, is, listen, it is, I said it was 0.1%. Like right now it's 0. 0.1% is pretty low. All right. So if they're going to charge me 0.1%, I could see that, if it started this way, I'd be like, oh, that's kind of reasonable. Like, again, they got a website, they've got stuff to manage, people to pay to do some stuff. 0.1% is, not unreasonable. What got me a little bit is that they're replacing Schwab for no cost, and vertically integrating it, themselves. So of course that's what they're doing, but it's still really low cost. I'm just throwing that out there because you got $10,000 in there. You're talking $10 a year. I mean, when you break it down to dollars, like $10 a year, it's really not, that much. So just be aware. Sometimes calculate the dollars and come up with the trade-offs. Like, yeah, 0.1% here and there does add up, but also just be aware, the whole point is to be aware what you're paying, what you're getting, and does it seem, reasonable to you?
On the other hand, if you've accrued $500,000, well, and this is less, I guess, in the HSA world, right? But it's more in like the, your investments. If you've got $500,000, then you're talking about $500 a year. I mean, that's something.
Well, it starts adding up. That's exactly right, Matt. So if you're saying like, hey, I've got the total U.S. stock market or the S&P 500, there are still funds, Matt, for the S&P 500 that charge 1% a year. And people have billions of dollars in those funds where you can get the exact same thing at 0.05%, 20.
Yeah, I was going to ask you. So a Vanguard, I have a number in my mind, and I almost don't want to say it out loud because I don't want to screw people up, but I have 0.043 as like the number, the fee on my Vanguard target date fund. It's something like that.
In my opinion, once you get below 0.1%, so 0.1%, anything in there is fine. So a lot of them are 0.05, 0.04. But anything less than 0.1 for a US index fund is, totally fine and go for it. And so, when you were looking, now we're looking at two different things. I said with the HSA, it's 0.1% that they're going to be charging me. You got 10,000, 20, 50,000, not a huge deal. But in index funds, where you're going to have $500,000, in your brokerage or your 401k or whatever, that's real money. Even that 0.2, if you go from a 0.2% down to a 0.1% or a 0.05%, that adds up every year. So it's worth paying attention to. But once you get below like 0.1, don't start, counting pennies. You're in a good spot.
Do you have a fee percentage that's like a cutoff for you where it's just the no way zone?
Not really. You mean in terms of like, going above that 0.1?
If a client came to you and said, hey, they want to charge me 0.25%, do you have a number where you're just like, no. Like you were just saying that if it's 0.05, if it's 0.1, it's like, that's okay. You're in an okay zone. Don't drive yourself crazy futzing around trying to get a little lower. But is there some number where it goes the other way and it's like, no, you can easily do much better and it's worth your while?
So if you're just in kind of low cost index funds, portfolios, like we talk about, for the US index funds, get below 0.2, get below 0.1, for those. For the internationals, get under 0.5. They're a little bit costlier, so 0.35, 0.25, somewhere around there. And then just compare what you can get, like I was saying before, the S&P 500, you can buy that same fund all the way up to 1%. So definitely like understand, hey, and you might be locked in. A lot of people are locked in. They've got huge capital gains. Maybe they bought it 20 years ago, and so switching it becomes a capital gains problem too. So you gotta, there's a lot to look at. But just keep them as low as possible.
It's just so hearing that 1%, it's just every time it smacks me in the faces. It's so obnoxious. Reminds me a little bit of, I don't think the cable company does this anymore, but it used to be a thing where if you called them up and you said, hey, could you lower my bill? They'd say yes.
Oh, that's still a thing. Yeah.
Well, what I heard, if that's the case, then I got a call to make as soon as we're done recording this episode. Because what I heard was they've stopped trying to fight it so much. They're not going to do a deal to retain you. I'm not sure what the economics of that is, but it definitely used to be a thing where you'd call them up and you'd have to go through some song and dance with a sales rep person who would try and sell you other products, get more information on you. But the bottom line is, if you were insistent, you said, no, I want you to sell me a different package. They'd say, oh, it turns out at the bottom of my stack of papers here, there is a promotion that I can give you. And I'd say, yeah, give me that. And they'd lower your bill like $1,000 a year. And it's so obnoxious. It's so obnoxious. All right. Well, you had a third story.
Yeah. Before I tell you the third story, that's the case, what you just mentioned in insurance providers. So general recommendations, every 3 to 4 years, shop around your insurance. You can get lower rates.
Actually, that happened to me. I'm going to throw the Lizard under the bus. I was with the Lizard for so many years, and I went to the overly peppy lady. And I saved seriously $2,000. $2,000 for no reason. I mean, it has to do with like what their underwriter assesses your risk as, and different underwriters. There's not like science to this. You'd think it's an actuarial thing. It's not.
Well, I would argue it probably is a science thing, but it's all a marketing scheme. So you can go the other way. You can go from the peppy lady back to the lizard in a couple of years and again, save $1,000, because what happens is they inch up every year because you stay with this. This is back to the cable story. Same thing. You stay with the same provider. So they just like keep inching it up.
They want you to switch. They want you to switch. So they're constant. So you can basically jujitsu it back on them and just do the churn if you're willing to take the time. I mean, it's a pain in the ass.
Yeah. Right.
Gosh, it goes back to that book. Do not steal that, dear listeners. Do not steal what I'm about to say. I so want to write my book, Everything's a Pain in the Ass. Because they make things intentionally a pain in the ass to, put sand in the gears, to create disincentives to doing this stuff. Wow, that is such a hot tip. We should have just done a whole show on that. Like, maybe I have to call my... Well, I just switched to the peppy lady, so I've got a couple.
You got to wait.
I'm going to call the cable company. All right, tell me your third story.
All right, here's the third story. It gets back to the value for what you're paying. So, my wife, as listeners know, is ER physician.
That was a terrible, terrible lead-in to saying your wife. The value for what you're... No. Do not follow that clause with my wife. No.
Oh, yeah.
Bad.
I was starting my story.
Damn it. All right, go ahead.
Well.
Your peril. Yes.
Yeah. At my own peril. She doesn't listen to the show anyway, so it'll be all right.
It was like the show The Problem with Jon Stewart, and it's like, maybe they should have put a comma after the word problem. We went to see a children's theater thing this weekend called How to Eat Like a Child. And my 11-year-old suggested that the show title would be improved by putting a comma before and after the word like. So it would read, How to Eat Like a Child?
I love it.
All right, cannibalism aside, go on. You're talking about the value you get out of your wife.
Is that what I was talking about?
I don't think it was what you meant to. Oh, okay. Your wife's out to dinner.
She was at the dinner with her physician friends. And this is what happens with physician friends, that they get hit up by people like me, not like me, financial advisors, other ones, right? So this is in the industry, like either physicians, doctors, lawyers, get hit up by financial advisors. So one of them was telling the story of, oh yeah, this company that helps manage our 401k, is also can help us out managing, overall investments. And they charge, like 1.5% of what they manage. And that's, typical 1%. It's kind of industry standard. So if you are managing $1 million for somebody, that 1% would be like $10,000 a year that you would pay to have an advisor, help you manage the money. And there's lots of things that the advisors do for that. We've had an episode on this and we could do another one. But that's not the point of this story. The point of this story is that she's having the conversation with the advisor. Oh, okay, it's all right. I see how you charge like 1.5%, on the first set of money. Is there any other way that you get paid? She was like smart enough to ask, okay, any other disclosures? Any other ways that you're like incentivized or paid? And the advisor like, oh yeah, also, when we put you in certain funds, we get a kickback from those funds, right?
Oh.
And so not only is the advisor getting paid by the client, a straight up fee, for managing the money, and they're getting paid for the kickbacks. And this is common. This is like what happens in my industry. It drives me crazy, like holy smokes. And good for her asking, follow-up question. Who would think to ask, further, like any other ways that you're paid, any other disclosures? And it drives me nuts that understanding, those fees, how much is that going to be, and it's not even they can tell you up front, like, okay, so how much am I getting charged? Like, well, it all depends how much we put you in different funds and right, all kinds of stuff. So it's all this wishy-washy. You can't even figure out what you're paying. And then you got to ask the other side, okay, for the $10,000 a year or $20,000 a year that I'm paying you, what am I getting? Bullet point out to me like, hey, here's the service. Here's what I'm getting every year. So then you can do a nice comparison. It's like, I always say it's like car shopping, right? There's all different kinds of cars. They're all different price points. But like, here's the kind of car I'm getting, here's how much it costs, and you can do a nice comparison, figure out what it is that makes sense for you. And the financial industry does not make any of that easy.
That one bothers me because in addition to the fee up front and the perverse incentive and the kickback, right? So now you've got a stack of you're paying the 1% plus the kickback fee plus what you don't know, which is the incentive for those funds that they're going to put you in for which they get kickbacks is the incentive to put you in funds that also have fees in them. So you're getting a stack on top of that. It's before you know it, like 3% of your investments, like the drag is insane. It's like usury. It's like going to a payday lender. Yeah. You know, it's that's so bad.
And let me tell you, Matt, they don't recommend low cost index funds because those guys aren't giving out kickbacks.
Oh, wow. That is, it reminds me of, it's like the second Harry Potter book where they tell Ginny Weasley, before you engage with any magical object, know where it keeps its brain, like know where something keeps its income, right? Like where are you drawing income from? And it's that, boy, it's just that confluence of ways that you're just bleeding out the nose, and the nose is the best end of that sentence. That one is bad. All right, let's bring it back around. So you said up front, KISS. We're going to keep it simple. Fees are the number one predictor of returns, and this is why. Three stories. If any of those stick with you, that's why.
There you go, man. Two things to take away. Low cost index fund, when you're doing your actual investments, keep the fees very low. And for everything in your life, understand the dollars you're paying for the value you're receiving so you can make an informed decision if that's something that makes sense for you.
Always know where something keeps its brain and gets its income. That's mine. And be careful how you start and finish your sentence so that you don't talk about getting value out of ... your wife. All right, let me wrap this up with our one thing segment. One very, very quick story that relates to all of our listeners. I was in the grocery store. I ran into acquaintance, friend around town, and he said, "Hey, I've been listening to your podcast." I'm like, "Oh, great, Beyond Politics." He's like, "No, the other one." Like,
the good one.
That one's good too. Well, that's what he said. He said, "Look, no," he's like, "Politics isn't my thing, but I'm all over the financial planning stuff." And he said, "Financial life planning with Mike Morton has saved me so much money." Literally, those are the words, so much money. He's like, "I just set up an HSA because I listened to that episode." I'm like, this is gold. Can I hit record right now? I mean, this is the best marketing in the world. So shout out to my unnamed man about town. This is a true story. And I hope that's true for everyone.
I think you buried the lead for this episode. Why is that not at the very top of the show?
I don't know. This is people who are already listening to this know that if they listen to this show, they're going to save lots of money, including by avoiding lots of obnoxious fees.
Great story. Appreciate hearing that, Matt.
All right. Well, thanks to all our listeners. And for Mike Morton and Matt Robison, we'll see you next time.
Thanks.
Thanks for joining us on Financial Life Planning. If you like what you heard, please subscribe to and rate the podcast on Apple iTunes or Spotify or wherever you get your podcasts. It makes a massive difference. If you have a comment or question, please email me, mike@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.